Welcome back. Before we proceed further, there are two fundamental questions that need to be answered. The first question is that why is it that AAA is getting a better rate compared to BBB in the markets? In both the scenarios, you got, if you look at the fixed rate, BBB gets 8%, AA gets 6.5%, and you can look at the floating rate, it's prime plus 0.75% is prime. Now, it is obviously the logic that AAA enjoys a superior credit worthiness, has a better credit rating, and therefore, the investors in this particular bank in terms or the lenders to this particular bank are more confident about recovery, more confident about recovery of the interest and principal, and therefore, the risk is less. In the risk being less, they are satisfied with a lower expected return. And that being the case, they are happier with quoting lower rates. So far it is quite simple. Therefore, the implication is that AA bank has a superior credit rating compared to BBB limited. Let us assume for the sake of further discussion that AAA bank has a credit rating of AAA and BBB limited has a credit rating of BBB. So, that means what? That means as far as both the rates are concerned, AAA has the absolute advantage over BBB in the fixed income market or in the borrowings market. But if you know, the second issue is, let us look at the spreads. The fixed rate spread is equal to 1.5%, 8% minus 6.5%. The floating rate spread is equal to prime plus 0.75 minus prime, that is 0.75%. So, the spreads are not equal. The spreads in the case of the fixed rate is higher, it is at 1.5%. The spread in the case of floating rate is lower, it is at 0.75%. This shows what is called the comparative advantage. The comparative advantage of BBB is in the floating rate market because the spread is lower here, and the comparative advantage of AAA bank is in the fixed rate market because the spread is more here. So, it is a natural corollary then that the party or the entity should borrow in that market in which it has a comparative advantage. BBB has a comparative advantage in the floating rate market, and therefore, it should borrow in the floating rate market, and AA having a comparative advantage in the fixed rate market should borrow in the fixed rate market. So, that is the second question answered. There is a very even more fundamental question. The question is, why do these spreads exist? The spreads exist. The concept of absolute advantage lies with AAA bank. Why? Because it has superior credibility, superior credit worthiness, and therefore lesser risk. BBB has a comparative advantage in floating rate market because the spread is lower. It is at a relatively lesser disadvantage compared to the disadvantage that it faces in the fixed rate market, and therefore, it should borrow in the floating rate market. That so far it sounds logical, but the more fundamental question is the existence of the spread. The answer to this is basically contained in the nature of these rates. When I talk about the nature of these rates, we have to understand the difference between the fixed rate and the floating rate. As I have been emphasizing, the fixed rate is fixed one and for all. For example, in this case we are talking about a 5-year funding. So, that fixed rate whatever is being quoted 6.5% for A and 8% for BBB is fixed once and for all for the entire period of 5 years that the funding relates to. Whereas, in the case of the floating rate, the rate is for a 6-month funding. Prime plus 0.5% for BBB and prime for A is the rate which is being quoted for a 6-month funding. Now, there are two things. One thing is that usually when the loan is rolled over in the case of a floating rate, the lender has the opportunity, has the discretion either to retain the same spread or the same rate over the market variable. In this case it is the prime rate, or to increase the spread over the market variable depending on the lender's perception of the future creditworthiness of the entity. In other words, this prime plus 0.75% that we are talking about at the moment is the rate that has been agreed at t equal to 0 for the first 6 months of funding. When the next 6 months of funding will start, the lender will probably be given the opportunity, or will have the opportunity to exercise discretion and either continue the rate or increase the rate, or in an extreme scenario to cancel the loan and not allow further rollover. However, in the case of fixed rate funding that we have, no such provision exists for a relook, for a reconsideration of the interest rates over the entire tenure of 5 years. You have to maintain the same rate over the entire tenure, irrespective of the change in the creditworthiness of the borrowing entity. So, that is a very fundamental difference. You see, it's very easy for a lender to assess the creditworthiness of an entity over a period of 6 months rather than over a period of 5 years. If you are talking about assessing creditworthiness over 5 years, that involves looking far into the future, and therefore, the risk is significantly more. But when you have the discretion to review and reassess the situation every 6 months, the risk is obviously less. And secondly, there is another issue. As far as the two entities are concerned, the entity BBB and the entity AAA, it is very clear that the entity BBB has a lower creditworthiness than entity AAA. Now, if BBB has a lower creditworthiness than AAA, the perception is very logical that as time passes, there is a significant chance that a default could well occur, or that or at least that the creditworthiness of BBB could deteriorate, could decrease, and therefore the perception is that the rate that is being quoted today for the first 6 months may not hold over the entire life of 5 years of the loan. And the perception of the market or the lenders is that there is a strong possibility of BBB's creditworthiness decreasing, and therefore, the lenders increasing the spread over the prime rate on subsequent rollovers. As a result of it, the effective cost over the 5 years will certainly not remain at prime plus 0.75%, it will definitely increase much more than that, and it would be comparable to the 8% that is quoted, that is being quoted for a fixed rate. So, that is the rationale that is given for this differential spread between the fixed rate and the floating rate. Because floating rate entails or enables a possible review at the end of shorter intervals, much shorter intervals, therefore, the risk content is reduced, and as a result of which, because the risk content is reduced, at least at the initial stage, you are willing, or a lender is willing to accept a lower interest rate than compared to a rate that applies for the entire life of the loan. Now, uses of interest rate swaps, well, there are two fundamental uses. One we have already encountered. You can convert a liability from a fixed rate to a floating rate, and the converse is also true. You can convert an asset from you can convert a fixed income stream from an asset into a floating income stream from the asset. It is just the reverse of converting the liability. Simply instead of converting a liability from fixed rate to a floating rate, you are simply converting a asset from a floating rate asset to a fixed rate asset. Now, motivations of swaps, well, this is a general sort of proposition. There are some examples that I will give you. You see, for example, a manufacturing company that has a significant fixed asset block, has a massive fixed asset block, may require or may prefer that fixed asset block be funded with fixed rate funding. Whereas a bank whose major composition of assets is financial instruments and therefore exposed to floating rate risk or fair value risk, for example, would prefer that the such assets are funded by floating rate instruments or floating rate liabilities. Now, it may so happen that when the manufacturer goes to the market or attempts to go to the market for fixed rate funding, it finds the rates very unfavorable. Market does not view it very well, and therefore, however, the market is more amen to floating rate to giving money to the manufacturing company at a floating rate, and therefore, the bank and the manufacturer may agree to borrow in different interest rates, manufacturer borrowing at floating rates, bank borrowing at fixed rates, and then entering into swaps. Another situation where a firm, which a US firm for example, which has borrowed in Japanese yen to finance capital equipment, but whose major sales operations are in the Middle East, which which result in a stream of US dollars, and because there is a mismatch in currency, wants to reduce the exchange rate risk, and as a result of which it wants to enter into a swap whereby the assets and liabilities are balanced, or the income stream is balanced with the liability for acquiring the capital goods, that is in Japanese yen, and this is another example where swap could come in handy. And another example where an American firm which is well known in the US can borrow at cheaper rates in the US, but because it is not well known in Europe, it cannot borrow in euros. However, it needs euro for its funding its projects. It may borrow in US dollars and enter into a swap to get euros. Another illustration where you have a portfolio of fixed rate assets, you perceive that the interest rates are likely to go up very significantly. So, what you want to do is you want to convert your assets to floating rate assets. You can again do that by doing an interest rate swap. So, these are some of the scenarios where swaps are pretty useful. Arguments for the existence of swap, we have talked about the comparative advantage theory. There can be other contributors to the value addition of swaps. For example, if a market is saturated with a particular type of or a particular window of instruments in that spectrum, it would be more appropriate for a person who wants to raise money in a different window of the spectrum, and then do a swap for what it desires in terms of its requirement. Financing norms, well, it's very much possible across countries, it's very much possible across industries as well. A particular nation, for example, in India, you may have different financing norms applicable to service industries, different norms applicable to manufacturing industries, and that may result in asymmetries in the market, in the lending market. Similarly, across countries also the same situation may prevail. Japanese may require a lower debt equity ratio, India, US may be happy with relatively higher debt equity ratios, and so on. So, these also contribute to value of swaps. You can borrow in a certain currency or a certain form which is optimum for you, which is optimum in terms of cost, and then enter into a swap with somebody else who also finds borrowing optimal in that other form, and thereby, if we take shown an example also, thereby swaps generate value for both the parties. And there can be different objectives of market players. You see, some people would prefer using swaps for hedging their risk as well. Entities that are exposed to currency risk may prefer swaps to to cut down the currency risk. We just had an example where an entity had borrowed in Japanese yen and then it had an income stream in US dollars. It can very well enter into a swap so that the exchange risk between that it's faced by the entity is reduced. So, this is the example of the quality spread differential or the comparative advantage. Little bit about swap quotations. For example, if you have a how they are quoted. For example, if you have a 2-year US dollar fixed to floating swap given as LIBOR plus 45/52, it simply means, and so let us say the LIBOR at the moment is 4.50, it simply means that the party that is giving this quote, the market maker who is giving this quote is willing to be the fixed rate payer at LIBOR plus 45 and is willing to be the fixed rate receiver at LIBOR plus 52. That is, it is having a spread of 7 basis points on the bid and ask side. The bid side quote is LIBOR plus 45 basis points and the ask side quote is LIBOR plus 52 basis points. So, that is how the quotes are given. For example, let me read it out. I am willing to be the fixed rate payer in a 2-year swap at a rate 45 basis point above current LIBOR, that is 4.95%. I am also willing to be the fixed rate receiver at 52 basis point over the current LIBOR, that is 5.02%. That is the meaning of this quote. So, he can be a payer at fixed rate payer at LIBOR plus 45, he can be a fixed rate receiver at LIBOR plus 52 basis points. Now, LIBOR, I hope the viewers are familiar. LIBOR is the rate of interest received which is prevailing in the London interbank market for short term maturities between 1 month and 12 months, the Reuters that notifies the LIBOR rate. So, it is a benchmark of short term lending rates between 1 to 12 months. So, what is a swap rate now? A swap rate is the fixed rate. Now, you see we have 2 rates as we just saw in the previous slide. There is a fixed rate where the swap market maker is prepared to pay, and the rate that he is willing to pay in exchange for LIBOR, and there is a rate that the market maker is willing to receive in exchange of LIBOR. That is, one is the bid rate and the other is the ask rate. The average of these two is called the swap rate. Effectively, what happens is, you see, if you have a bond with a principal of 100 units and if you have a certain swap rate, then a coupon, a half yearly coupon with that swap rate, if discounted at the appropriate LIBORs, will be quoted at par. I repeat, you have a bond with a face value of say 100 rupees or 100 units of money and coupon rate equal to the swap rate, and if it is discounted at the LIBOR of various maturities, then it would be quoted at par. That is the meaning of swap rate. Now, there is a slight difference. There is a slight difference between the swap rate and the fixed rate. For example, if you are talking about a swap rate and a fixed rate, let us say of over a 5-year period. A swap rate basically is a rate that is equal in terms of credit risk or that corresponds to a credit risk. This is very important. A rate that corresponds in terms of credit risk to a rollover borrowing, to a lending rather, to a lending of 6 months each over this period of 5 years. In other words, there will be 10 such lendings, consecutive lendings 0 to 6 months, 6 to 12 months to different entities, and the risk that entails this kind of scenario as captured by a single rate will give the swap rate. Now, why it is slightly lower than the swap rate is, of course, the credit worthiness of each of these borrowing entities must be AA at least. minimum of AA. Now, the difference between a 5-year fixed rate and this particular rate has to be understood. In the case of a 5-year rate, there is no scope for any review or reassessment. However, in the case of this 6-monthly rate, which is being consecutively rolled over or consecutively made to different entities, at the end of each 6 months, the rate can be reviewed and reassessed. Therefore, the risk attached to this particular stream, where we have a consecutive lending of 6 months over the entire life of the 5-year period, is much less than the risk attached to a one time review over, that is to hold over the entire period of 5 years. So, that is the important thing, that here you can have assessments at the end of every 6-month period. However, in the case of a 5-year loan or 5-year lending, the assessment can be made only once. And therefore, in the earlier case, when you have a consecutive lending to different entities, the risk level is lower, and therefore, the interest rate, the swap rate is relatively lower than the fixed rate. Then 0 rate is the YTM of a 0 coupon bond, and swap rate we have already talked about. Let us take an example to clarify the concept of swap rate. The market on a particular day is quoting a swap rate of 5% for a swap whose payments are made semi-annually. Suppose that the 6-month, 12-month and 18-month 0 rates have been determined at 4%, 4.5% and 4.8% with continuous compounding. What is the 2-year 0 rate? This 5-year swap rate means what? If you have a coupon of 100 units of money, if you have a bond of 100 units of money face value, and you have a coupon equal to swap rate, that is equal to 5% in this given problem, because the swap rate is 5%, then semi-annual payments at the rate of 5 years per annum compounded semi-annually, that is 2.5 per every semi-annual period, and if discounted at the relevant LIBOR, should result in the par value of the coupon, and that is precisely what we are going to do. At the end of 6 months, you see what are the LIBOR rates for 6 months, 12 months and 18 months, 4%, 4.5% and 4.8%. So, what are the cash flows? We have to work out the rate for 2 years. So, what are the cash flows? At t equal to 0, there is no cash flow, obviously no cash flow. At t equal to the first 6 months, there will be a cash flow of 2.5 end of first 6 months. This will be discounted at the LIBOR applicable to the first 6 months, which is 4% here. So, we are continuous compounding is given. So, we will use continuous compounding 2.5 e to the power minus 0.040. Then 2.5 at the end of 1 year, second coupon payment discounted for 1 year. What rate? 4.5%, that is the 1 year rate. Then the third coupon payment 2.5, which is to be discounted at 4.8%, this occurs at 18 months. And then the final payment, which is to occur at 2 years, because the swap rate is for 2 years. Just have a look. Swap rate 5%, on a particular swap rate of 5%, swap was paid semi-annual, 2-year 0 rate. So, at the end of 2 years, what will happen? We will have the fourth coupon payment, but the principal will also be refunded. So, the total cash flow will be 100, which is the principal refunding or the face value being refunded, and the 2.5, that is the coupon payment, and that will be discounted at the rate that we have to calculate. And this whole thing must equal the par value, because we are given that 5% is the swap rate. Given that this 5% is the swap rate, this whole expression on the left hand side must equal the par value, and if you solve this, you get R is equal to 4.953%. So, swap rate is that rate such that if a coupon has a value of 100, face value of 100, and the swap rate is equal to the coupon rate, swap rate is equal to the coupon rate, and if it is discounted at the various spot rates which are prevailing, you get the par value of the bond. Day count issues I have already alluded to earlier, I will not repeat it. But basically, you see, the normal practice in money market is that we have actual upon 360 as the day count convention, whereas in the case of bond markets we have actual upon 365 as the convention, day count convention. So, therefore, the problem arises when we are, if the floating leg is quoted in terms of actual upon 360 and the fixed leg is quoted in terms of actual upon 365. In this case, they are not directly comparable. Either you convert the floating rate into an equivalent 365 convention basis by multiplying by 365 upon 360, or do the inverse with the fixed rate to make them comparable. And this is some information about the various dates that are associated with the swap. The trade date is the swap at which the swap deal is negotiated, the swap deal is finalized. Effective date is the date from which the swap becomes effective, from which the swap starts to operate. As I mentioned, floating rate are fixed at the beginning of the period to which they relate, and the payment of interest, however, takes place at the end of the period. DS is the date at which the interest rate, the floating rate is set. D1 is the date from which the interest rate begins to accrue. D2 is the date on which the interest becomes due. So, D1 is the date from which the interest rate starts to accrue, D2 is the date when it is due, and DS is the date when it is set. DS is the date when it is set, D1 is the date it begins to accrue, and D2 is the date it becomes due for payment. Now, we talk about the most important part of this particular discussion, the concept of valuation of a swap. We have talked about valuation of a forward rate agreement, we discussed this earlier. We now talk about valuation of a swap. To start with, when I talked about an interest rate swap, I also said that an interest rate swap can be considered as equivalent to an exchange of a fixed rate and a floating rate bond. Therefore, if we can value the fixed rate bond and if we can value the floating rate bond, then the difference between the two will yield the value of the swap. And second thing, please note, the value of a swap will be, say it is x, then it is x for one party and minus x for the other party, because it is a zero sum game. So, what x is and what minus x is, that is the big issue. Let us start. We all know how to value a fixed rate bond. It is quite straightforward. It simply calculate the present value of all future cash flows that emanate from the bond, discounted at the appropriate risk adjusted rates. And this is the philosophy of valuing a fixed rate bond. Valuing of a floating rate bond is more or less similar, but there is a catch. The catch is this: see, when you are talking about a floating rate bond, the interest rate is not fixed. And because the interest rate is not fixed, it is not like you multiply on every interest rate payment date, you simply work out the interest using the interest rate that is given to you already. You do not have any interest rate that is given to you, that is the problem. But there is a solution. The solution is that in the case of a floating rate bond, we have a benchmark, and the interest rate that is paid on the benchmark, on the bond, the interest rate that is paid on the bond is related to the interest rate on the benchmark or the benchmark itself. For example, if a bond is paying LIBOR, then the interest rate on the bond is LIBOR, and the bond is going to be discounted also at the LIBOR, because LIBOR is the appropriate discount rate. So, therefore, in the case of a floating rate bond, what happens? Suppose suppose a bond is simply paying LIBOR. At t equal to 0, what will happen? For all future dates, the bond's interest rate will be calibrated with respect to the LIBOR, but at the same time the same LIBOR will be used for discounting that interest rate cash flow. And we know that if the coupon rate of a bond is equal to the rate of discounting, the bond is quoted at par. Precisely the same thing is happening in this case. In this case, what is happening is the coupon rate happens to be the LIBOR and the rate of discounting also happens to be the LIBOR, and therefore, at least at t equal to 0, the bond will be worth at its par value. In fact, the same argument can be extended to any future date. At any future date, once the interest is stripped off for that period, whatever remains on that interest payment date, any future interest payment date, I mean, on that interest payment date, once the interest payment is stripped off, whatever remains will simply be the principal value of the bond. Let me reiterate. So, at t equal to 0, my first payment will be at the LIBOR that is fixed at t equal to 0. Let us say I have only one payment, that is at LIBOR at t equal to 1. LIBOR is fixed at t equal to 0. The rate at which I will discount this LIBOR payment, of course, the principal will also be repaid, will also be LIBOR, and therefore, I will end up with the present value equal to the face value. The coupon rate is nothing but the discount rate, and that happens if the bond is having a life of 2 years, 3 years and any years. And that also happens if instead of t equal to 0, I value the bond at any future date on which the interest payment takes place. Once that interest payment is stripped off from the bond, whatever remains for the bond will be nothing but the face value of the bond. This is the fundamental principle of valuing a floating rate bond. Then another question can be asked is whether what happens if the bond pays LIBOR plus 1%. That 1% is a fixed rate, so you can value it separately and add it to the value of the bond. That is not a problem at all. That is a fixed rate, it can be valued as any other fixed rate bond. So, we are essentially focusing on valuing a bond which is related to a given floating rate, and that is how floating rate bonds are valued. We will take up this example in the next class. Thank you.